Good afternoon, everybody. Welcome back to Markets for Millennials for the weekly market wrap here from March 14th to March 18th. And the focus that I wanted to have for today is that we've had some breakouts. And right now, there's no telling whether these breakouts are going to hold sway, if this is the sign that we've already bottomed out and we're just going to be moving on to all-time highs. Or if it's, or if this is just a little bounce that's taking place, kind of like a dead cat bounce before we head lower. So I'm looking here at the S&P, and I'm just going to give you a reference point here. So we watched the yield curve quite a bit. I don't usually post about it in my videos, but just looking at the yield curve, obviously you can see how back here in 2019 we went below zero, inverted, so that led to the COVID crash, or that was going into the COVID crash, so it signaled a recession long before COVID. I mean, you can kind of see that we're kind of heading back down to those levels. Now we're still a little ways away, but a lot of people have been looking at other yield curves. So, for example, the U.S. 5-year minus, or the 10 minus the 5. So we did have an inversion. Was it this one? I'm trying to remember. Let me go back to my candles for a second. So we did go negative for a brief moment on the 10 minus 5. And then if we go US 10 minus US 7, 7 here. If we do that, that curve is negative. So basically what a lot of people are doing is they're watching multiple yield curves. Obviously the 10 minus 7 is not as important as the 10 minus 2, which is what I was looking at prior. That's the big one that signals the recession. But it is on a huge downtrend. That's something that we were watching. I was watching last week. And then we also were watching credit spreads. And although the credit spreads have come down this week from where they were, the trend is still up. And that's something that we want to watch for, because obviously back here during the March 2020 crisis, the spreads just blew out. And so that's usually a signal that things are going wrong. That's something that the Fed looks at, definitely, and a lot of people in the markets look at. Now, coming back to the S&P, one of the big news event that we had this week was that we had the FOMC meeting. They did raise rates by 25 basis points, which was expected. And on that news, so here you actually see on the March 16th candle, we were up almost 100 points on the S&P. And what was interesting about that is that on Tuesday, even before the FOMC announcement, on the first day of that meeting, we were up 90 points on the S&P. And so on the week, just a huge weekly candle here, up 6%, over 6%. And you can just see all the different weekly candles that we took out to the upside. And what I'm showing you here, and I showed you those the yield curve, and I showed you the treasury spreads, or the bond spreads, because I wanted you to just understand the backdrop of what's going on. At the same time, on all the major indices except for the Dow, we have decent breakouts. So I've got a couple things to show you here. First of all, we have kind of this level, this green horizontal, which was a support level. We were able to get above that. You'll notice that the support came with a confluence from this descending trend line, which I've had basically ever since this February 10th candle. It's been right here. And if you go back on the videos, you'll see that I've had that trend line there on the S&P. So you'll notice that confluence, we broke through it on the follow-through yesterday, after the FOMC meeting. So sometimes what will happen is the market will move a certain direction on the news from the FOMC meeting, and then the next day it will reverse direction. In this case, we've had follow-through 2 days in a row to the upside. And even today, we opened down and since retraced and came back up. Now, I will say this, if we come back and we look at the March 2020 crash. This one happened very, very quickly. And in this case, the closest thing that I can say as far as like what happened that it may look similar is we had this candle up on March 2nd of 2020, and then it looked like we were going to start selling down again. But then we had another daily candle that moved up, and we took out a couple of the daily levels that were on the downside. We took them out, and then we still ended up selling down. So it's not to say that just because we've had this follow through doesn't mean that it's not still just a dead cat bounce. You can kind of see here back in the end of January and into early February, we had a couple of solid days in a row before eventually rolling over. But the reason why I'm curious about this one, and actually I'll show you my NASDAQ chart because I'll be looking at the NASDAQ in just a second. I had this chart, and I had a couple of other charts that I had posted and this is just one of them, and it was just signaling that we were starting to get a breakout, and I wasn't really sure what to make of it. If I actually go back, let me see if I can do this really quick. I posted this chart as well, what I was watching. I'm going to show you this on the Russell. I took a screenshot of this. This is kind of the S&P chart that we've been looking at. So all that to say, this was something that I was watching to see, because not only do we have this confluence of the trend line plus the horizontal resistance level, but we also had this little wick on March 3rd, which was kind of the little wick high from this little bounce before we rolled back down and rolled over. And what I think is interesting to note is that we took out all of those levels. And so this is a pretty clean breakout, and I think it's hard to know. I've been asking myself, are we getting to the point now where we're kind of bottoming, and is this correction now over? And nothing is certain, but we've definitely cleared a couple of the levels to the downside. Now, this is why for weeks I've been telling you guys, when you've been watching this channel, I've been telling you guys that taking trades to the short side is a lot more risky, because typically those moves to the downside, they say that the markets take the stairs up and the elevator down. So these moves can happen really fast, and then you never really know, when the bottom has been hit. And so obviously there's potential to gain on the downside, but it can recover relatively quickly. And even on dead cat bounces, if this is going to roll over and head back down on the dead cat bounces, if you're not responsibly placing stop losses and things like that, then you can get taken out a lot more easily, and you can lose your positions. And so that's something to note. So like anybody who was taking trades to the downside using this little swing high as a stop loss, they've been taken out now if they didn't get out earlier. So that's why those kinds of things are important. So in this case, because of where the trend line touches, if I had a short, my stop loss would have been up here. And then obviously the safest stop loss is up here, because that's the highest point. But inevitably the markets, if you just zoom out, the markets go up and to the right. So you just have to be really, really careful. And that's why I typically stay away from shorting as much as possible. But we've gotten above some pretty significant levels. So the next levels that I'm really paying attention to, so I have this horizontal level, which was support back here. But really, like, probably the best level to watch for next is right around here, which that's coming in. Let's see, that's coming in right around 45.80 or so. I want to see us get above that, and then a lot more damage will have been repaired. But even now, like, if you were to go and take a look at from our little wick peak, now we are only 7.5% down from our all-time high in terms of the wicks. So definitely this correction has been, even though it's taken a while to unfold, the correction has been relatively soft on the S&P compared to, say, the NASDAQ, where we've also had a considerable breakout here. And The only difference is that in this case, we actually we have a more shallow trend line that I want to see us get above, because we peaked back in November and then did not make a higher high in December like we did on the S&P and Dow. But in terms of like the initial repair, this is definitely another considerable breakout, getting above our these two swing lows, which were right here and right here, getting above this closing high, and then obviously above these wicks as well, getting above this descending trend line. Just again, a lot of really solid things happening here. To me, it's a big deal that we took out our closing lows here on daily, and we took out the wick low, and then we still ended up making a higher high. To me, that's really important. That's really solid. And even though we're just kind of barely closing above that level, still important to me. Now, again, there's no guarantees. We could still roll over. But this is looking about as good as it possibly could, given the macro backdrop, given the whole thing with treasury yields, credit spreads, given the geopolitical instability and uncertainty. I think what the markets have been happy about, honestly, is even though you would think like, oh, well, look at yields. We'll just take a detour for a second and look at yields, right? Yields are up. We're up above 2%, pretty comfortably above 2%. And so you would think that the tech stocks would be getting really, really hurt, but the markets love certainty. And so the markets had priced in that there were rate cuts happening, and they didn't do anything more hawkish. And in fact, in my opinion, came out a lot more dovish because they weren't talking about tightening. They didn't seem to be in much of a hurry to do like extra rate hikes, or even like more sharp rate hikes, like nothing in the 50 basis point or 75 basis point or 100 basis point range. So to me, like the market had priced in the fact that there were going to be rate hikes. And so, I mean, unless something changes drastically, like again, like even here on the NASDAQ, it looks pretty good. I'll skip to the Russell because I showed you on a chart on my Twitter. I kind of just built in this wedge pattern, which is kind of like another version of what I think we were seeing across most of 2021, just kind of a slowly tightening range. And it really doesn't matter whether you want to, let me try to widen this out a little bit, whether you want to look at it as kind of a pennant, or whether you think that this should be kind of more of a flat bottom instead of angled like a trend line. Doesn't really matter. Point being, we broke out of that range, and basically any way you slice this, like we broke out of from our prairie dog and then from our January 4th wick, we broke out of that. We broke out of a horizontal level. We broke out of this pendant that I drew in here. So even the Russell, which by the way, just to remind you, had even though it's been down over the last, since the end of January, it has outperformed the the S&P and the NASDAQ for sure. So that's just something to watch. The only one, like I said, that has not totally confirmed but was starting to today is the Dow. And you can actually see we got above our swing high. That's this yellow line. Broke back above this this horizontal support, or what is now support. So the only thing that we have left here to match what's happening on the other indices is that we get above this trend line. And then the next thing I'll be looking at on the Dow, at least, is to really not really even this trend line, this horizontal resistance at 35,054. It's more to get above 35,720-ish, somewhere in that range. That'll get us above this swing high. And that'll be, again, another confirmation making a higher high. So that's going to be something I'm going to be watching for. Interestingly, the dollar, after having broken out of this, what looked like an ascending wedge to me, is now starting to consolidate. We have failed to make a higher high this week than what we did last week. And so that is something to note. And so I'm looking ahead, are we going to make another sort of flag or pendant like this? I've got a couple of different lines that I'm watching on the bottom, on the downside. I've got what was resistance and is now support. You can see that it's holding so far, even though we have wicked below it yesterday, and also on the 10th last week. That's a level to watch. It's also this horizontal level, which if you pull back a bit, that has been a level of support and resistance over the course of time over the years. So that is something to watch. Important to notice here that there's the confluence right there. I think that's why we're holding here. And yeah, I mean, like, it's hard to say what's going to happen on the dollar. I suspect, I feel like it's going to go up more. I think we're going to get to 100, but I could be totally wrong. And we could end up coming back down. I do think in the long run, I think a couple of years from now, maybe even later this year, maybe 2023, I don't really know when, I do think we're going to get, a move back down to the lower 90s and even into the upper 80s and perhaps even lower. But I do think for the time being, we're going to keep our dollar bullish bias because for the last, year almost, the dollar has been bullish. So, and again, that is compared to other currencies. And it's interesting to note too, the euro has been strengthening, but the Japanese yen, and I posted this. Let me show you this chart first. This is my euro chart I've talked about before, versus the US dollar, the Great Britain pound, the Australian dollar, and the Japanese yen. And by far the biggest one that the euro is appreciating against is the Japanese yen. And I'll show you what I was looking at earlier, because this is the Japanese yen against the US dollar, euro, pound, and Australian dollar. And you can see the Japanese yen is getting just destroyed all across the board, across most of the foreign exchange markets. And so definitely that's a big risk on move then. If you're not going into the Japanese yen and even the Swiss franc, then it's going to be more risk on. And that kind of matches what we've seen on the equity markets the last couple of days, especially on the NASDAQ, which has made a really solid recovery this week, being up over 8%, even more than the S&P was. So I think a lot of the dollar weakness was coming from the bounce in the euro. But then you've also, if you, let's see, let me go USD, Japanese yen. Let me just show you this chart by itself. You can actually see we've had some really strong moves in the dollar versus the yen, over 2% last week, over 1.5% this week. Just again, the Japanese yen, I think, is something like 20% or so of the DXY. So not quite as high as the euro, but that I think does pull some weight for sure. Looking back again at yields, I had this dotted line. If you follow my mouse across the screen, this dotted line had been the line that I was looking at previously. It provided the support on, we bounced around it on, between the beginning of March and the first week of March in general. And now what I've done is I've taken a line and I've drawn it from the March 30th, 2021 peak to now our peak in February. You can kind of see that it looks like we're coming in to test. We had a wick down, we had another wick almost touch. And so what I'm going to be watching is, will we be able to hold this area on yields? And if I actually just pull back, you can actually see on my chart, on the weekly chart, you can kind of see this long descending channel. This is the bond bull market essentially. And so just to give you an idea of that blue line, and you can see that blue line right now from today is coming in at just under around 257, 258, 260, somewhere in that range. And so we'll see what happens if we even get close to the top of that range or not. Something definitely that I'm watching, but like I said, definitely watching that support level. And then gold. If you actually look at things like gold and also oil, we're getting a pretty good bounce, and I added this trend line, which I'm going to be watching for now. I feel like the macro and all the geopolitical situation, inflation, and all that, I think is good for oil. Let me turn the lines off because that'll make it a little bit easier to see. I think the backdrop is still good for oil. But it's really interesting that we did get that kind of that cool off, which I think let's go from the bottom of this wick. That's almost a 50% retracement if you go back to the beginning of December 2021. When you have that kind of price action where it just kind of goes parabolic, you're going to get, a check, you're going to get a pullback, and obviously we gave back most of it. I think that it still is okay. I think that, I guess the near to medium term picture on oil is still pretty good. But again, because we had this big sell down, I'm still going to be cautious. And then on gold, I think it's interesting because you could see actually that gold and oil were generally doing the same thing over the last couple of weeks with the Russia situation. I know I keep switching back and forth, but I just want you to see the similarity in price action over the last couple of weeks. And then today, with oil up, gold is down considerably. I think I can't see this very well. Gold down over 1% today. This looks almost like an engulfing candle versus the day before. So we have a couple of inside candles. We haven't taken out this daily candle from March 15th. So very interesting to note. Silver also feeling a little bit of that pain. I just think it's just amazing to me how we were getting close to touching our all-time wick high at 2078, and now we're $150 off that, just real fast. So I don't know. It's hard to know. It feels like, if the market is pricing in a Fed policy error, policy mistake, then it feels like gold is, still in a relatively good position. But I just don't like to see that kind of price action in gold, because it's kind of like the same thing that we saw back here in August of 2020. We got that huge move up, a sharp sell-off, kind of consolidated, and then we started that long downturn, or that long sideways and downwards consolidation and correction. So I don't really like to see that, and that's just my opinion. And then finally on Bitcoin here, Bitcoin has been holding up pretty well, all things considered. We had that wick bottom January 24th. We were down, let's see, this level is 32,992, and we have not hit that level again. And we keep toying with all these different levels. You can kind of see here I've got all these different lines. I've got to erase some of them, honestly. I've got some dotted lines here because I'm tracking all sorts of different things. Don't want to get too distracted. But yeah, I mean, all things considered, it looks like we're getting a little bit of a bottom here, and that when you look at all of the on-chain stuff, obviously our fundamentals are well and good. We just need the catalyst for demand, and we've got the Bitcoin bond, which could be offered at any time. I think they scheduled it to be offered between the 15th and the 20th. The 20th is on Sunday, so we'll see if they start to launch it sometime this weekend, or if it's gonna be next week. But that obviously could be a new catalyst, and there could be any sorts of other catalysts. I know that's something that a lot of people are talking about. You got to create some demand, and the big thing that I've been talking about on Twitter and whatnot is there's not a lot of retail doesn't have dry powder to buy, and institutions are still waiting. I think because they're waiting for regulatory clarity, and so I think that's something we're gonna have to wait for a while. And then just a quick look at the VIX. I wanted to just point this out. I was looking at this recently. I talked a while back. I had mentioned that I thought it was interesting that we, in the midst of the increasing tensions and uncertainty, that we did not get up above this level close to 40. We didn't even get a wick above it. I just think that's really interesting. So we were actually making lower highs on the VIX, and now we've come down quite a bit. And so it doesn't really matter which way you slice it. If we're gonna do a trend line, like it looks like we're we're at the lowest possible level, or perhaps closing at the lowest possible level to maintain the trend on the VIX. So I'm going to be watching that next week too. And watching the VIX will be a pretty good sign also to complement what's happening on the equity markets. For all we know, that this could be, like I said, we could be on our way back down in terms of volatility, and that'll be good for the equity markets. So that's the look at the markets. Again, I think it's best to just be cautious at this point because it's not certain that this is going to go back up to all-time highs, but it is reason for optimism, and so we can be cautiously optimistic going forward. So thanks for watching. I hope you enjoyed this video. If you liked the content, please remember to hit the like button and share it with somebody that you think would find it helpful. And I'll see you guys next time.